Here is a detailed summary of Marvell Technology Incorporated's Q2 fiscal year 2026 earnings call transcript, designed for clear and concise delivery. Introduction. Good afternoon, everyone, and welcome to Marvell Technology's second quarter fiscal year 2026 earnings conference call. Today, we'll be discussing our financial results and outlook. Please note that our comments today may include forward-looking statements subject to risks and uncertainties. A reconciliation of GAAP to non-GAAP measures is available in our press release. Key financial metrics. Q2 FY 2026, Marvell delivered a strong second quarter of fiscal year 2026, achieving record revenue of $2.006 billion. This represents a 6% increase sequentially, and a substantial 58% growth year-over-year. Data Center. This remains our strongest growth engine, contributing 74% of total revenue. It grew 69% year-over-year, driven significantly by AI demand. Enterprise Networking and Carrier Infrastructure. These markets showed a solid recovery, collectively growing 43% year-over-year. Gross margin. Our non-GAAP gross margin was 59.4%. Profitability. We delivered record non-GAAP earnings per share, EPS, of 67 cents, a remarkable 123% increase year-over-year. Operating cash flow. Generated $462 million in operating cash flow, up significantly from the previous quarter. Management's forecast for future quarters. Q3 FY 2026 total revenue. We forecast total company revenue to be approximately $2.06 billion at the midpoint, representing 36% year-over-year growth. Excluding the divested automotive Ethernet business, this implies a go-forward business growth of closer to 40% year-over-year. Q3 FY 2026 data center, expected to be flat sequentially. Strength in electro-optics will be offset by slightly lower custom revenue in this quarter, with custom revenue expected to be stronger in Q4. Year-over-year, data center is projected to grow in the mid-30% range. Q3 FY 2026 Enterprise Networking and Carrier Infrastructure anticipates sequential growth of approximately 30%. Q3 FY 2026 Consumer, expected to be down low single digits sequentially. Q3 FY 2026 Automotive and Industrial. With the automotive Ethernet divestiture, we anticipate approximately $35 million from this segment. Non-GAAP EPS growth, projected to grow 10% sequentially at the midpoint for Q3, outpacing revenue growth and demonstrating continued operating leverage. Significant risk factors. Forward-looking statements. As noted at the beginning, our forward-looking statements are subject to significant risks and uncertainties. Investors should refer to our SEC filings for detailed risk factors. Lumpiness in custom business. The custom silicon business, particularly large hyperscale projects, can exhibit sequential lumpiness due to ramp schedules. While Q3 sees a brief digestion period, Q4 is expected to be substantially stronger. Supply chain. While we have strong partnerships and execution, the supply chain remains tight and requires very close coordination with customers and our team. Tariffs. The tariff environment is dynamic, but to date, we have not seen a significant impact on our business. Highlights. Record revenue and EPS. Achieved record revenue and a substantial increase in non-GAAP EPS. Strong data center momentum. Driven by robust AI demand, the data center segment continues its impressive growth trajectory. AI market expansion. The total addressable market for data center custom silicon has expanded to an estimated $94 billion for calendar 2028. Custom silicon design wins. We have an expanded pipeline of over 50 new opportunities, with additional multi-billion-dollar lifetime revenue potential secured since our June event. We are targeting 20% market share in data center by calendar 2028, up from 13% in calendar 2024. Automotive Ethernet divestiture. successfully completed the $2.5 billion all-cash divestiture of our automotive Ethernet business, providing capital flexibility. Leadership enhancements. Promoted Chris Koopmans to President and COO, and Sandeep Bharati to President, Data Center Group, to further capitalize on AI and cloud opportunities. Scale-up networking opportunity. Significant investments are being made in developing scale-up switches and interconnects to support evolving AI data center architectures. Electro-optics leadership. Strong demand for our PAM and DCI franchises, with shipments of next-generation 1.6T PAM DSPs beginning. Core business recovery. Enterprise networking and carrier infrastructure are showing a strong recovery, with significant sequential growth expected in Q3. Capital allocation. The auto divestiture proceeds provide flexibility for stock repurchases and strategic investments. Lowlight sequential decline in custom revenue. Q3 forecast. While expected to rebound in Q4, custom silicon revenue is forecast to be flat sequentially in Q3 as part of a broader digestion period for some large hyperscale projects. Consumer revenue decline. Consumer revenue is expected to be down sequentially in the low single digits in Q3 due to seasonality. Most important statements from CEO Matt Murphy. Marvell delivered record revenue of $2.006 billion, reflecting a 6% sequential increase and strong 58% year-over-year growth. Our data center end market continued its strong momentum, growing 69% year-over-year, fueled by robust AI demand. The auto divestiture aligns with our strategy to focus the company on what we expect to continue to be a massive AI opportunity in front of us by purposely redirecting our investments towards data center relative to our other end markets. We hosted a highly successful custom silicon investor event in June, where we outlined an expanded $94 billion data center total addressable market for calendar 2028, a 26% increase from our prior view. Our success in the initial wave of custom programs has expanded our design win pipeline to over 50 new opportunities. Collectively, these new wins represent multi-billion-dollar lifetime revenue potential. We are very satisfied with the company's performance and see significant opportunities ahead. Most important statements from CFO Willem Meintjes. Revenue in the second quarter was $2.006 billion, growing 58% year-over-year and 6% sequentially. Non-GAAP earnings per diluted share was 67 cents, reflecting year-over-year growth of 123%, which is more than double the pace of revenue growth, demonstrating the significant operating leverage in our model. Cash flow from operations in the second quarter was approximately $462 million, growing by $129 million from the prior quarter. We recently completed the divestiture of our automotive Ethernet business in a $2.5 billion all-cash transaction. Proceeds from this sale give us flexibility to continue to drive our ongoing stock repurchase program, as well as invest further in our technology capabilities. We expect total company revenue to be in the range of $2.06 billion, plus or minus 5% for the third quarter. Our debt ratios have continued to improve as we have driven an increase in our EBITDA. Concluding remarks: we are executing on our strategy, driving strong revenue growth, and expanding our operating margins. The divestiture of automotive Ethernet provides significant flexibility, and our balance sheet remains strong. We are very pleased with our Q2 results and our Q3 guidance, which reflect the continued strength of our data center business driven by AI, coupled with a strong recovery in our enterprise networking and carrier infrastructure segments. Our custom AI engagements are at an all-time high, and we are confident in our ability to achieve our long-term custom revenue goals. Thank you for your interest in Marvell. We look forward to speaking with you again soon.